Hi, and welcome back to Express videos for ACCA paper F7. Remember, download your Express notes, which are the basis for these Express videos, from our website at www.theexpgroup.com. Now we'll focus on chapter 4, which actually deals with construction contracts. It's a merely application of the IAS 18 revenue recognition, which we covered in one of our previous videos. What is the scope of this standard is the first thing that should be fairly clear for you in the exam. So under IAS 11 will fall all the contracts where basically we sign a contract to build a block of apartments, and then basically we sell them. If I first build the apartments and then sell it, that is just inventory under IAS 2. It will never be accounted for under IAS 11 construction contracts, okay? The idea with a construction contract is that these are big projects or slightly fairly less bigger projects. It can take only 3 months, but as long as passes an accounting year end, that will be reflected at in accordance with IAS 11. Before this standard was into place, what the builders or the contractors will actually do, they have a number of years where they just incur losses because they didn't know whether or not the project will be profitable, and then one big huge bonanza year, if you want, where the profits are skyrocketing. So imagine yourself, you are a constructor, and basically for 3 years in a row your financial statements will show, I don't know, loss of 1,000, loss of 2,000, and boom, a profit of 10,000. So in terms of relevant, useful, comparable information, we do not actually fulfill neither of them. So that's why basically IAS 11 is telling us how to account for it, and how to account for the contract is merely to find a way to match the activity and profits over the life of the contract. And if you remember IAS 18, we can do this by reference to stage of completion. So I will actually book revenues and part of cost by reference to how much I have actually worked under this contract. So a summary of the accounting treatment for construction contract is presented to us in the following diagram. There are two types of contracts. One which are basically signed at a markup. So no matter what the costs are, for building a villa, okay, I will charge you cost plus 5%. Cost plus 5%. So in here, the recognition of profits and cost is not a problem, okay? Cost of $1 million, mark it up with 5%, that would be the revenue for the year. If you see this in your exam, that will probably be, I don't know, 3 marks. When we have a fixed price contract, which basically says, well, let's say we actually contracted to build a ship, or to build an airplane, or to build a new terminal in an airport, something bigger, okay? Usually this is done for a fixed price. So let's say I sign up for, I don't know, 22 million to actually build a terminal, an extension to the airport, okay? So in this case, it will matter exactly whether or not I will be able to keep the cost as per the initial estimation under the contract, because the revenues will not exceed the 22 million which I just made up. So in here there is a pretty important distinction that needs to be done between profit-making contracts or loss-making contracts. Because if you are foreseeing at certain stage in the project, imagine it will take me like, I don't know, 2 years to actually, 3 years, let's say, to finish off the terminal, okay? If somewhere between these 3 years I actually foresee a loss, that one should be recognized in full in P&L according to the prudence concept. On the other hand, if the contract is profit-making and I am able to actually evaluate the outcome of the contract with reasonable certainty, meaning I know my costs and my cost to complete the contract, then I can actually recognize the attributable profit that is earned by reference to stage of completion. If on the other hand I cannot yet estimate the total cost that I will incur to actually finish off the terminal, I will actually match the revenues to the costs incurred, so in order not to show any profit or loss. So if I do not know the outcome of the contract, it is prudent not to basically show to the users of the financial statements any profit or any loss. Then the question is, how can we estimate the stage of completion? And basically the standard describes two common ways. One is called work certified. What is that actually meaning? An independent valuer or surveyor will come to the construction site, will take a look at what we have built, and they will say, I don't know, 30% of the terminal is built. So therefore, I am allowed to recognize 30% of the revenues, 30% of the cost, and therefore 30% of the profit under this contract. Or, if I'm not using work certified, I can use the cost incurred to date by actually dividing the cost incurred over the total cost on the contract. Then I will come up probably from the same project, I don't know, 33% is done. The most common method in the exam, it will be work certified basis. So the approach for the exam is pretty important, and it will help you remember if you actually keep in mind what you're trying to do. You have to reflect into the statement of financial position and income statement most of the times for the period the outcome or the work under a construction contract. The first thing to decide, if you remember our decision tree, is whether or not the contract is profit or loss making. Because if it's loss making, I have to book the loss in full as soon as I foresee it. But if on the other hand the contract is making a profit, I am allowed to actually reflect part of this profit only by reference to stage of completion. And that's why the second step in your exam, once you decide that the contract is profit making, to work out your percentage of completion. Remember, either using work certified or using the cost incurred basis. And then you will recognize the turnover on the contract by just multiplying the total revenues or the selling price of the contract, which will not change, with your percentage of completion. You will recognize cost of the contract by multiplying the expected total cost to finish off the terminal in our example, multiplied with the stage of completion percentage. For loss-making contracts, okay, you will actually make the cost as a balancing item in order to fully recognize the loss as soon as you foresee it. And then what you have to do is to finish off the statement of financial procedure figures using a pro forma workings as is actually given to us a little bit below. And the pro forma working will say that in the statement of financial position, I will actually have only one line, which is called amounts due to or from customers. And that can actually be calculated using the following pro forma. Costs incurred, which is X amount. Any profit or loss in the contract that you already recognized to date, which can be, if it's a profit, you add it up. If it's a loss, you deduct it. Less amounts billed, or in other words, says in short, billings to your customers. The outcome, if it's positive, it will be an asset, or it will be a liability if it's negative, meaning you actually worked for your customers but they didn't pay you the full amount, or you receive more than the actual work that you performed under this contract. This pro forma, you need to actually learn it for the exam. The statement of comprehensive income figures, meaning your percentage of the revenue and cost, it will be easier to remember. There are previous standards like IAS 18 revenue recognition, which says that as long as you're providing a service, because in effect what you're doing, you're just building something, okay? You have to recognize it by stage of completion, and that will trigger your memory. With respect to statement of financial position, the pro forma needs to be learned, okay? How much are the costs today that you incur under the project, plus minus any profit or loss, less the billings to your customer, will give you an asset or will give you a liability at the year end in the statement of financial position. So if you're basically looking on how to reflect this in the exam, let me take you a fairly short example. Let's assume you have project A and project B, and you'll be given the following information. The price, the selling price for which you basically contracted those projects are, let's say, 500 and 1,000. The cost date, meaning how much you actually spent in the contract, is 200 for project A, and let's say 220 for project B. Cost to complete project A and project B are, let's say here, 200, and in here they are unknown. It's too soon. You just started the project and therefore you don't know how much it will cost you to actually finish it. But you contract it at a fixed price of 1,000. Work certified by an independent surveyor up to the date is 150 and 200 respectively, and billings to your customers under this contract are 140 and 160. And you will be asked in the exam, based on this data, basically to produce the statement of comprehensive income and the statement of financial position at the year end. The beauty with these questions in the exam is the fact that the examiner will have to give you all of the numbers. All you have to remember is what to do with them in the exam. So for that, you'll basically go back to the exam approach technique, which we covered a little bit earlier. And we said that the first thing is basically to decide whether or not the contract is going to be profitable or not. And in our case, basically we will have selling price of 500, cost to date less cost to complete of 400, and therefore the profit under this contract it's $100. For project B, I have a selling price of 1,000. I know that up to date I actually spent 220, but I don't know how much will I actually spend until the project is finished. So in here I cannot tell you whether or not this will be profit or it will be loss making. And the way, once you establish this, the way to reflect this in the exam, it will be fairly straightforward. For the one that is going to make a profit, project A, I will be actually reflecting by reference to stage of completion. And for project B, that will be the first one for you to reflect in the exam, because as far as you don't know it, IAS 11 says if you don't know, then don't show me any profit, any losses deriving out of this contract. So basically, work certified to date, let's use this one as reference of stage of completion based on work certified, because that's the second step in your exam. I have to calculate my stage of completion. So basically, for project A, work certified is 150 over 500, which is actually 30%. For project B, work certified to date is 200 out of 1,000, which is fairly straightforward, 20%. Now, all you are left to do is to prepare the income statement figure and the statement of financial position figure. And you will always start in the exam with the statement of comprehensive income figure. And I will have to show revenues, and revenues are shown by reference to a stage of completion, meaning what I will have to do is multiply my percentage with the contract price. So project A will actually reflect 150 as revenue and 200. Let's finish off project A. We'll have 150, and 150 will actually be obtained by multiplying 500 with 30%. Costs under this project, it will be again percentage multiplied with total cost. Total cost for us is 400 times 30%. That's 120. And therefore, the profit recognized to date is just 30. And if you are looking at the stage of completion, you finished off 30% of the project. You estimate that your total profit is 100. You are entitled to recognize from the total profit 30%. That will be your check in the exam. For project B, it's even more simple. In here, since I don't know, all I want to do is show no profit, no loss. But I cannot ignore the cost incurred. So the cost to date were 220, we say, and therefore I will make the revenue as a balancing item in order to show no profit, no loss today. I will not use the stage of completion. And then pretty much produce the statement of financial position figures, and in here you need to know the pro forma. Project A, project B. It will be cost incurred, add up any profit or loss, less your billings. And in here we will reflect the cost incurred, meaning you'll go up and take your cost to date. Okay? Cost to date is 200 and 220. So what I will have in here is 200, 220. Profit and loss recognized in the contract, 30 and nothing. And progress billings to date, it will have to be given to you in the exam. Sorry, 140 and 140 and 160 respectively. So 140 taken out from those figures and 160 in respect to project B. So 230, that's basically 140, that is $90. And in here 220 less 160, that's $60. Both are assets. So I provided work in excess of the amounts which were actually billed to me. And this is how you'll basically reflect in the financial statements a construction contract.